It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me today, well, golly bee, it's Michael B. Michael Becker's in the house, the governor of the great state of real estate in Texas. Michael and his crew own, 8, 9, 10,000 units. Michael at probably one time had 15, 16, 17,000 units. Now he's down a couple thousand, but always a pleasure to talk with Michael Becker. Michael, how are you?
Staying busy, Paul. Things are, school's back. Summer's still hot, but summer's basically over. Trying to get a few more things done before the year's over. So just been busy buying, selling, refinancing, doing a little bit of everything right now.
You guys over at SPI are always busy, so we'll ask you a little bit in the future about what you guys are doing. But have you been watching the Netflix documentary series on Jerry Jones and the Cowboys?
Yeah, I'm down to the last episode, so I gotta finish the last one up. I saw the first six or seven, so it's been great.
Yeah, they have, I think, 8 episodes. I'm on episode number 3, which is really the Cowboys being bought by Jerry, and what the reason was that Bum Bright sold the Cowboys to Jerry, and then Jerry putting the money out to buy the Cowboys, and maybe a little historical about how he got his money. As I was understanding it, that he bought the Cowboys for $140 million back in 1988, 89, and he put in $90 million of his own money, and then he borrowed the rest, or he put it out for other investors. Well, so whether he borrowed it or he had investors in, he was the controlling general partner of the Cowboys back at that period of time. And really the Netflix documentary kind of shows the trials and tribulations about buying a company, buying an asset, and then trying to make it work. It has similar themes to what we do in multifamily investing. Jerry, who spent $140 million in cash, now that asset, the Cowboys, is probably worth, what, $10 billion? It's the highest valued team of any major sporting team in the world, I think. Mike, what else did you pick up in that documentary?
Yeah, someone that was our two people here both were talking. We're in town when all that was going on. It was kind of trip down memory lane, kind of seeing how big the Cowboys were back in the day and all the big games and big plays. And I remember a lot of that stuff and some of the off-field antics and some of the crazy stuff you had to deal with. And you haven't gotten to it yet, but where the NFL was suing him and he was suing the NFL over how they advertise and the revenue streams and things like that. It was, he's been a controversial figure for 37 years or something like that in town. And he came in as a carpetbagger from Arkansas, taking it over and firing Tom Landry, and how, that he was a hero and Jerry was the villain. And it's just kind of just fascinating and interesting to kind of relive all that from my youth. When I was in high school, the Cowboys won, 3 of the 4 years they won the Super Bowl. So it's been a long 30 years or so since that time period. And maybe this is our year. I doubt it, but maybe this is our year that we do a little bit better. But it was a fun thing, and I'd certainly encourage people to watch that as their little pop culture section of this podcast today.
You bet. So you were out speaking last night to a group of, I'd say, fairly new investors. A group had you out. You spoke with, lots and lots of, I would say, would you say newbie investors, Michael? And then what did you kind of talk about? Because really the question for Ask Mike Mondays is, what's going on in the direction? What are you guys seeing out there? What did you talk about at the meeting so people can get your insight without actually going to that meeting last night?
Yeah. It was our mutual friend, Dustin Miles, and has a little meetup he does. I'm not quite sure how often, but maybe quarterly or something like that. And spoke at it back years and years, maybe pre-COVID. I think was the last time I spoke at it. And then this time, so it was good. It was sign of the times where, back a few years ago, you go speak at one of these things, there'll be 200-300 people there pretty easily. And that last night was probably 40 to 50, which was great. I mean, it was good to see, but all these people were kind of, for the most part, there's a couple of familiar faces, but for the most part was fresh and new or trying to get into the business and trying to really figure it out. And kind of the next wave of new investors were likely in the room last night. Just kind of talked a little bit about kind of the history of my probably 20 years in the industry, from being a banker to being, or 20 plus I guess at this point, from being a banker to being owner for 12, I guess my 12th going on my 13th year of owning multifamily and being a longtime lender before that. And some of the stuff that we've seen and some of the parallels of what I'm kind of feeling like today's environment is relative to the last cycle kind of point in the market, and some of the just kind of state of the market and what we're observing. And there's some as I mentioned on this podcast before, kind of feel bipolar sometimes, Paul. Sometimes things are great and things are going good, and then you turn around and you got 20 problems to deal with because it's problem business. And there's varying degrees of issues that you're always kind of having to work through, whether it's on the capital side or the operational side, or whatever. There's always a problem in this business. But that's what we're here for, is to solve problems. So that's why I got a job, I guess.
Yeah. So a lot of people may have not heard you speak about what your history is. Can you just do an elevator pitch for people that would kind of want to know what your background is before you start talking a little bit about the state of the industry?
Yeah, professional background, like I mentioned, is in the came out of the banking industry, like you, Paul. We have that in common, and that's kind of how we get along so well, as kind of shared history and that, and started pre-Great Recession, where banking was a good profession and every role respected, and then about 5-6 years out of college, all of a sudden, the great financial crisis happened, and we became a hated industry overnight. And I did problem loan workout for better part of 18, 20 months, where all those decisions that the bankers made in the big lead up, you had to live with those consequences and try to get your money back. And that was an interesting time. And in the middle of that, I worked for a regional bank that got bought by Wells Fargo, so I spent better part of 4.5 years at Wells Fargo, with the first part of that doing problem loan workout. Then when we started stopped working deals out and started making loans again, what was working was multifamily. So Paul was my biggest referral source when I worked at the bank, and we did probably almost 100 loans together over about a 3-year period, where as Paul would say, were kind of Humpty Dumpty loans. All those broken deals from the great financial crisis, we'd kind of put a bridge loan on them, reposition both from operational standpoint and basically every case, a physical standpoint, allow our borrowers to kind of put them together and reposition them, sell them, or refinance them once the properties were fixed. And I kind of through that process realized this was the wrong side of all those deals. So started buying investment real estate in 2011, kind of smaller stuff, my own money, and started getting into the multifamily larger syndication space in 2013. So 12 years ago, and I think we counted 19,000 units ago. Here we are.
And did you start out, you did a bunch of single family stuff for you personally, and then then SPI got into buying some of these Class C properties. Did you guys do all these large value added rehabs, or what kind of rehabs did you do? And after the financial crisis, a lot of these properties were not in good shape. So did you guys do the first version of the rehab, the second version of the rehab? Tell us a little bit more about, how deep did you get into these value add?
Yeah, the first handful of years was, real Class C workforce housing. Think 1960s, 1970s, vintage, suburban, old crappy apartments, basically. So it was the 1.0, Paul. Like there wasn't as wide. It was a kind of the infancy stage to do, value add upgrades to the common areas and the units. Cause think back before 08, kind of the early 2000s, late 90s, we just built a ton of apartments, and the stuff from the 70s was 20 to 30 years old, and the 80s stuff was less than 20 years old at that time. And everyone was buying houses because you could just fog a mirror and get a mortgage, so it was really hard to push rents, and it didn't make sense to do upgrades. Just wasn't in the marketplace. And then coming out of the Great Recession, that became a thing. So there's a couple of trailblazers and clients of ours that we made loans to that were some of the first people to really go in and turn the almond or bisque or white appliances to black, and do little glass backsplashes, and do dog yards and things like that. It just wasn't in the marketplace. So that's kind of what we started with. And, we didn't do anything intentionally do anything super dirty, but, some of the first deals had a chiller, system for the HVAC, or had, all had cast iron and had some deferred maintenance. So we've had to do foundations and quite a bit of deferred maintenance as long as the upgrades. But you got paid for it back then. And as the market matured over the last cycle, the cap rates got lower, and you go back and listen to us talking about that in real time. And the prices went up, and the returns, from a cap rate perspective, were kind of similar to what, something that was, maybe brand new or 10 years old. You'd pay kind of a similar cap rate for the new stuff as the old stuff. So we took the opportunity, sold and buy new over the last cycle. So if you look at what we own today, most of it's 20 years and younger, and, newer, better, nicer, bigger. And we sold kind of the older stuff. So, the parallel is kind of like we're kind of similar to maybe 2011, 2012, kind of the last cycle. It kind of feels like we're a similar kind of point in the cycle to, say, 2011. It's kind of what it feels like. And these older deals are starting to get a little more interesting.
Yeah, I think that's what the direction I wanted to talk a little bit about is you guys started off buying some of these older Class C properties. You upgraded when you saw the cap rates were all pretty much the same, whether it was A, B, or C class, highest quality to the lowest quality. They were all kind of not valued the same, but I guess the denominator was pretty much the same, that they were all pretty much equal. So why buy a crappy property where you could buy a nicer property? And that's why you guys moved into buying nicer properties. But now, when these values had hit peaks, you guys have bought a number of properties that were a little older. You bought some properties up, I believe, in Denton, one around White Rock Lake. You're also looking at some older properties. So is it time in the past to look for the future? Tell me a little bit about what you're seeing out there that a lot of people are not seeing.
Yeah, starting to think, is it time to get my Marty McFly analogy and get in the DeLorean and go back in time and start buying some of the older stuff again? And that's really kind of the conversation we have a lot around here. And we bought selectively a small portfolio last year, and we're in the process of doing one right now. That's an 80s deal. And thought process is, when I first started in 2013, bought our first deal, Dallas Fort Worth, buy a brand new Class A deal for about a 5 cap. A B deal, which was like 80s at the time, was like a 6 to 6.5 cap. And a C deal, 60s or 70s, was like 8 to 8.5 cap. And then at the peak, they all kind of between 4.25, 4.5. So, the risk adjusted returns weren't there. So we sold old, bought new kind of along the way. And now, as the interest rates went up 5% in 2022, and, the rent growth went from positive to negative, and these people are over levered a lot in the older space. As the cap rates have kind of expanded, better quality, higher class stuff is pretty sticky, and the bottom lesser stuff is the cap rates are blowing out. So the values are degrading faster. And now that spread is probably, brand new Class A is kind of high 4s to 5. 80 stuff is kind of generally that 6% range, maybe a little higher, maybe a little lower. And then the 70 stuff, it's really hard to trade a 70s deal unless it has at least a 7 cap on it. And then the 60 stuff, I don't know, it's kind of all over. The better stuff, better located, smaller deals trade a little easier. If you have a 500 unit 60s deal in the hood, no one wants that, it's just almost no bid. But you're starting to get paid for that risk. So that's really kind of what it is. And you buy a well-located 80s deal that's been renovated, and you be in the low to mid 6s, and you can borrow money in the low 5s. You have 100 basis points of positive leverage, plus maybe some upside and rental rates and other things that, kind of make some sense. That's kind of what starting to make sense. And, do you want to do 100 of those? I don't know. We want to do a couple of them. I think the answer is yes. So that's kind of where we're at. And, the difference between 12 years ago and today for us as a company had no track record, no background, no profile back then. So everything we got, we're faking it till we make it kind of type of thing. And now we kind of made it, and profile's good in the marketplace, and sellers and brokers recognize that, we have a higher level of certainty. And that's, when these guys need to pay their mortgage off by the end of the month, or they're going to get foreclosed on, certainty matters. So you're getting better better prices. So we're going to win, Paul, probably, 9 out of 10 jump balls. So if we're there, similar price, we'll probably get a lower price compared to the less than proven group. As I've said repeatedly on this podcast for many years, it's a completely unfair business. Who you know, what your track record is, what chips you could trade, all those things come into play. So I'm going to win more than I'm not if I go into that space. So the question is, do I want to win a bunch of it and buy it? I still think there's quite a bit of value in the newer, nicer stuff as well. But Dallas, the values are off the bottom on the Class A, and it's harder to make that makes sense. But if you want to go to, say, San Antonio or Houston or Austin's frozen right now, but you can buy some some newer stuff down there a little easier in Dallas. Dallas is a freaking knife fight for the Class A stuff, and values are on the move up.
Talk a little bit about last comment that Austin is frozen. What does that mean? I know that you were just down in San Antonio looking at an asset. You guys have some assets, some apartments down in Austin. What's going on with Austin?
And Austin's tough, right? I mean, you got this headline to read about all the supply and concessions. I mean, they're real. There's depends on the pocket and things like that, but it'd be some of the highest supply submarkets. They're like 10, 12 weeks of concessions. I mean, that's pretty tough if you own up there. I mean, that's pretty tough. Given we got 12 months in the year and 3 of them go away for free, that's hard to make money. So that's a moment in time, and so what's happening is, if you own there, like, you're doing everything you can not to sell. Like, you'd be, crazy to try to sell in today's values. So you don't want to sell. So the only people selling have, unfortunately have to sell by and large. And there's always exceptions to that, but that's generally kind of the rule down there. So there's very limited inventory that's on the market. But the demand everyone's seeing, like, this is a great entry point if you could buy at today's values. That's a moment in time where concessions are impacting the NOI, and you should be able to buy at a good, attractive point, and the future's brighter, and it'll work itself out, and you'll make a bunch of money if you buy today, which I agree with. But so what's happening, though, is the limited inventory that goes to market gets bid up because there's a lot of money chasing limited inventory. So his cap rates are getting really compressed, and it's going beyond where we have felt comfortable buying. So it's really hard to transact in Austin right now. So very little is getting done, where Dallas is much more liquid. There's more inventory. His fundamentals are better, and it's just trading. And these values are going up because all these institutions are in town are buying it. Then everyone else is following the leader. So more, every day that goes by, there's more and more participants trying to buy, and we'll see. There's a big surge of listings that are about to come out in kind of that Class A space over post Labor Day, and we'll see kind of how those trade out between now and then the year. But it seems like pricing is going to start has started moving up, and I think it will kind of continue to accelerate upwards as more people believe that the supply is turned off, and fundamentals are close to recovering, and more and more groups are making bets on that thesis, Paul.
When is Netflix going to do the Michael Becker story, similar to Jerry Jones in building value? Buying a property or buying a business and building value, and then holding it on for years, and then watching it grow. Do you see that coming down anytime? The Michael Becker story.
I don't quite have the flair of a Jerry Jones I have a few country witticisms, but his are a little better than mine. So should take some notes on that. But yeah, no, I think to your point, I mean, it's just it seems like a great time in the marketplace. And when Jerry bought the Cowboys, Bum Bright, the prior owner, was in real estate, banking, oil and gas, and it was the late '80s, and Dallas was in a major recession. The banking industry, the S&L crisis was in full effect, and he had to go, and sell the deal. I don't think he wanted to; he had to. So that's some parallels to that. To what there's finally starting to come in the market. Things that we thought would have happened maybe last year, or maybe hell, even in the year before, seeing some more pressure. It's really been kind of delayed, but the clock seems to be running out on more and more people. In particular, if you own an older deal and then you had a bridge loan and you bought in 21, 22, the clock is running out. So you see more and more of those kind of come to market, and the more of those that kind of clear, then it resets expectations, and then nature's kind of healing. So it's just a process that these deals have to kind of work through the system. And once they work through, then we're going to be on the backside and start recovering. And, so I talked to someone last night that has a deal that, bought in 21, they refinanced it last year on a 5-year Fannie Mae loan. And she was kind of asking me, well, how much time, do we need? And I was like, I mean, to get back to where you were in 21, you probably need to get to 2028, maybe 29. And you have the timeline. She's like, well, my investors want distributions and, yada, yada, yada. I'm like, well, as I mentioned in my last newsletter, the market doesn't care what you need, right? The market's going to do what the market's going to do. And either you want to recognize that loss now or you want to, ride it out. Those are your two options. And I think you need to stop caring about what you want or what you thought you were going to do and to start dealing with reality of what the marketplace is. And hopefully I've done a pretty good job of trying to recognize what reality is. And you just got to make the best decision with what information is in front of you at that moment in time. And, ride it. You just got to ride it out. So if you wanted to sell, you should have sold a couple years ago when the market was down a little bit. And now the market's down a lot. So if you want to sell today, it's not a good outcome. So, you just got to live forward. And the older the deal and the lesser the physical characteristics of the deal or the worse location of the deal, the tougher it's going to be. Those are going to be the first deals that recover are the nicest, best located stuff. And then you go down the grade to the next rung and the next rung. And the bottom rung of that ladder is the last that's going to recover. So it's the first to go in the crapper and the last one out. So it's just the way the world works. So if you own a 60s or 70s deal, you just got to ride it out. And if you have the time, you'll be fine.
Absolutely. So I took a lot of notes there, so I appreciate that. Look for the new Netflix documentary, Michael Becker, Real Estate Superstar. So, Michael, if people want to get more information about what you and your team over at SPI does, what's the best way for them to get in contact with you? And again, what do you do? What is SPI?
So we've been doing multifamily projects for dozen years now. I guess at this point, going on our 13th year. And we, try to find, any point in the cycle, what we think is a relative value. So, right now, recently it's been newer, nicer, bigger, better, and we're still doing that. But we're also kind of starting to get interested in some of the older stuff, like you could buy a deal where the guy, is in it for, X and you could buy it for, X minus 20% or 30% or whatever, where you're buying it around their debt basis. And, he did a pretty good job, but the market just moved against him. That seems like a compelling investment thesis to me. So we're just trying to put out high quality deals for, for investment to our database. If you want to get information about what we do or see our future opportunities, or we do a quarterly newsletter every quarter, kind of what we're seeing in the marketplace and state of the market. You just go to our website, which is spiadvisory.com. SPI like Sam Paul Igloo advisory.com, and there's a form you can fill out to get into our database, so to see opportunities, get the newsletter. That'd be the best way to kind of see what we're doing, and we should hopefully have something before the too long to put out for investment and take advantage of that bonus depreciation that is now back at 100% in 2025, which is great, and if not, it's a good way to kind of follow along and learn if you're kind of newer and you kind of see what we're doing and follow on the market. So what's going on with you guys? I know you have what are we up to, the 9th or 10th annual Old Capital Conference coming up? What are we at this year?
A lot of Old Capital conferences in the past. So coming up October 8th and 9th here in the Dallas-Fort Worth area, up in Frisco, Texas, we have the Old Capital Conference. This is the big conference of the year. There's 300, 400, 500 people that show up for this conference. We have a lot of people that are knowledge-based. They know what the heck they're talking about. We have lenders there. We have management companies there. We have everybody that's talking real estate. We'll have a great guest speaker that is going to be our keynote speaker this year. Again, it is.
Tell us who it is, Paul, or is that still a secret?
Can't tell you that. It's at FC Dallas up in the Frisco area. Again, taking advantage of the coming future World Cup coming up next year. So we thought we'd keep that theme going. So go to oldcapitalconference.com, Old Capital Conference, and get on our list to be an RSVP participant in there. Again, it's a great networking opportunity, meeting the folks, and maybe we'll get Michael Becker to show up and you can say hello to him and spend some time
Sounds great,
with him.
Paul. Is that thousands and thousands of dollars to attend, or
It's
what does
thousands
that
and
look
thousands
like?
of dollars to attend, but if you know Michael Becker, we can get a discount for you. So I
Yeah.
actually don't know what it costs, but go on to the RSVP of Old Capital Conference and it'll show you what the cost is.
And a plug for Paul and James and their conference, the Old Capital Conference. It just got a couple to a few $100 to attend, and it's one of the best attended events in the industry. And there's a lot of these kind of conferences that I get invited to speak on panels, and they're all kind of cookie cutter and the same. And it's all these people that work for other people that then go to these conferences and they try to pitch you some sort of software or whatever. Where this is real people in the room that are actually doing deals, and other sponsors and lenders that are actually making loans, and brokers that are actually selling these properties. So this is kind of I think of it like a deal makers conference in a lot of ways. There's a lot of great education and speakers that you can learn if you're new into it. But if you have any serious interest in doing multifamily, specifically in Texas, there's people that are actually doing deals, and investors and brokers. And I find it to be, the very unique, and it's not like all those other conferences I won't name that you kind of get on their distribution list, and some generic conference room of a generic hotel somewhere in Dallas or Houston or Austin or wherever they have those. So I would encourage you guys to attend. It's I think your ninth or 10th one, and always have a interesting flair, and it's entertaining, educational, but it's actually actionable, and you get to meet people actually doing deals. And I would encourage you guys to come out.
I have to remember to put a little extra in your paycheck next week, Michael. Michael's not paid spokesman for Old Capital, but we certainly do appreciate him saying some good words. We thank him for being on the podcast today. Again, thanks, Michael Becker, for Ask Mike Mondays. I'm Paul Peebles. Have a great day.